what we're doing today is we actually arriving at the end of a project that took us 6 months of really hard work. And some of you might be familiar with this work from previous year. But we are publishing our report based on a global ETF trading survey. So my job here, if I refer to how the last panel discussion ended, is really when you heard about some of the top picks for what ETFs to invest in. What I'm going to tell you about is like how to trade those top picks, or more importantly, or more interestingly, what findings from my report seem to suggest about investors trading ETFs. The survey, in a nutshell, I said that it's really exciting content that we have. Just to give you a flavor of the scale of the work that has been done, we asked questions about ETF trading to 296 institutional investors around the globe. And you can see the breakdown of what type of firms participated very kindly in this survey. Just to, again, illustrate the scale, the combined assets controlled by those institutional investors that participated exceeds the $20 trillion. So it's a pretty broad and wide overreaching survey that we have. And what I can do here within the 10-minute slot is really just only make a teaser out of it. So share some of the findings that we thought are most interesting or maybe more surprising. But very much I encourage you all to get familiar with the whole study. You will be able to download it. It's online available. You also have physical copies here and at our stand in the exhibition room. So to start with, I think the first reflection that we wanted to highlight as a finding of this report is the perception about ETF liquidity. We asked those institutional clients involved in the survey if they think that ETFs are more liquid than they were 3 years ago. And guess what? 90% or around 90% of the respondents indicated that they think ETFs are more liquid than they were 3 years ago. This is a pretty big vote of confidence from the client community. And interestingly, as you can see, it comes across different asset classes too. So it's not specific just to one type of ETFs. On the back of that, we also wondered about if there's a change in why institutional clients are actually trading ETFs. Now again, this is a trading survey, not an asset allocation or investment type survey. But it's interesting to see that 1/3 or slightly more than 1/3 of the respondents indicated that they trade ETFs for core asset allocation purposes. I'm saying this is interesting because it is probably not what many of you associated with the use of ETFs, tactical or asset allocation rotation plays or liquidity management would be more typical uses for ETFs. And we think that this links very nicely with the story of confidence in availability of liquidity. So it's a consequence of the fact that investors have faith that they can actually find the liquidity that they need. That also obviously means that sizes that are being executed in ETFs are growing. That is something that we have found through the survey. As you can see, there's an increase in 2018 compared to 2017. This is obviously also something we see every day when we are trading ETFs with our clients. You might have come across some of our messaging about the largest ETF trade ever that we have done this year, in excess of $5 billion in a single transaction executed by a client. So it really seems that ETFs are finding its way to core asset allocation application as well. Why is it possible? Okay, confidence in liquidity is one factor, but I think probably even more importantly, the factor that is at play here is cost. So because of that, we have asked the question, what is the most important factor that you pay attention to when you are selecting counterparties that you trade your ETFs with? And competitive pricing came out decisively on top. So 55% of the respondents globally indicated that the main criterion that they use when they select counterparties to trade ETFs with is competitive pricing. And you can see some of the other responses, and you can see that the generic value add / research is ranked fairly low on that list. If we look at Europe specifically, and that is probably not surprising given that we are in a MiFID II year, the percentage of investors who indicated competitive pricing as the most important factor is even higher. So 71% of the respondents indicated that what they pay most attention to is competitive pricing. Again, I would like to think that there's a story here. And this story is investors are able to source ETFs with lower cost of trading because they are paying attention to competitive pricing. Therefore, trade sizes are growing. Therefore, ETFs are being more applicable also for core asset allocation purposes. You might argue that some of this is also linked to broader factors at play. Regulatory aspect is clear. MiFID, the focus on best execution, unbundling of research, that is probably a big driver in Europe. But something that is true globally, I think, is the effect of fee compression in the industry. So asset management is obviously experiencing a big change in terms of fees going down across the board. And I think that results in firms paying much more attention to individual costs that are components of the total cost of ownership. So what actually goes into the total cost of running a position, and trading cost is one of the important factors there. And as a result, we tend to see investors paying much more attention to competitive pricing as a factor when they are selecting who they trade the ETFs positions with. What it means in practice is that providers who focus on competitive pricing tend to be selected more as those who institutional clients surveyed by us like to work on ETF trading. So independent market makers, that was already the top category in the previous year. We have seen an increase in 2018. More than 1/3 of respondents globally say that they select independent market makers as counterparties where they trade ETFs. And then we see changes elsewhere. I would say probably the unbundling and the segregation of trading costs from other services that clients expect from the brokers and price providers is at play here, particularly when you see agency brokers being a category that is going down here. That can likely be explained by what we have seen on a previous chart, i.e. the relatively low focus on the ancillary services, if you like, so research provision and other types of services that brokers would typically deliver to the counterparties. Again, in total, I would like to believe that this tells you a certain story about ETF market. I think one conclusion that I would draw out of it is that it bodes well for the future of ETFs if they are finding more application in investor portfolios, if focus on competitive pricing allows for lower cost of trading, and if the confidence in the ability to source liquidity in ETFs is so overwhelmingly rising, I would like to think that we're going to see a continuation of growth of ETF usage across the board.